everyone, and welcome to another edition of Between the Lines Live. My name is Vanessa Rader, I'm the Head of Research at Ray White, and today I'm joined with my esteemed panel. We're going to talk about all things hotels. So hotels is a pretty interesting topic at the moment, so we're joined by Adam Ellis. Adam is the National Director and Partner of Ray White Valuations in the Hotels Division, and we've got Andrew Jackson, and we'll call him Jacko, who's our National Director also of Accommodation at HTL Property. So welcome, guys.
Good to be here.
Thanks for having me.
I think the hotel market is one of those markets that everyone's been talking about over the last little while. Certainly one of the most impacted asset classes during COVID. And also everyone you know has been on holidays, going on holidays, and there's certainly a resurgence in that part of the market. Not to mention the whole Taylor Swift effect, all the events coming back and a lot of increases in average daily room rates and occupancy. But before we kind of delve into what 2024 has in store for the hotel market, let's start with kind of where we have been. And can you give me a few observations of kind of what did you see during 2023?
We'll start off with Vanessa. Hotels is a great market. It's good people, good assets, and it's a fun asset class to work in. Last year we saw around about $2.4 billion in sales, hotel sales across the country last year, which was above the long-term average in Australia, but very similar to 2022. And in that market there was an unusually high level of domestic buyers in that market, which was unusual. The hotel market is usually dominated in Australia for big ticket items by offshore buyers. But last year there was a good component of around about 70% of domestic buyers in the market, which was good to see.
Yeah.
I think one of the things that dominated last year, one of the key themes, which may have been across all asset classes, was the cost of debt, and there's a bit of uncertainty about where debt levels, what the cost of debt was going to end up being on a stabilised basis. So that was a key feature of last year, I think.
2023.
Yep.
And with your agent hat on, Jacko, what did you see in terms of that transaction level? We saw kind of high transaction activity, and what was 2023 for you?
Yeah, deal flow was more subdued last year than it had been the previous year. There was still a number of big ticket item deals, and it was dominated by domestic buyers, private family offices, high net worth buyers, that sort of buyer segment class. It was less prevalent from the offshore international buyers last year, that's for sure.
Yeah, well, the hotel market, I always kind of, when you look at those transaction numbers, you always see the Malaysian, Singapore in particular, quite fond of a large hotel asset, but yeah, not to be last year. But what is 2024 going to bring us in terms of hotels? Do we think we'll see some of that change in the purchaser type? What sort of inquiry have you been getting, Jacko, in terms of hotel activity this year? Do you think that we'll see some of those kind of offshore buyers come back in, or has there been some increased inquiry?
Yeah, listen, inquiry's been really encouraging to start the year. We've only really just kicked off, obviously, but it's been very encouraging to date, and definitely that has been noticeable. We've got a noticeable increase now in offshore interest, international buyers that we do expect to come back in this year, and there's a lot of factors to that. I mean, we still think there'll be domestic private buyers dominant this year, particularly portfolio owners, existing portfolio owners that have just they've got a real advantage. They know the market, they've got established systems in place, established relationships with our banking system and finance in place, but definitely there'll be an inflow of investor interest from overseas, and we're seeing that.
Yeah. And like we said, the Taylor Swift effect is just one of them, but we've certainly seen daily room rates up, RevPARs, or maybe explain what RevPAR is for everybody.
Revenue per available room, which is average rate multiplied by occupancy. Yeah.
So we're seeing improvements in all those kind of indicators. So what do you think 2024 is going to bring for that broader part of the market?
Well, the first thing is to look at hotels often in this respect, get benchmarked to pre-COVID levels as to where the market is today compared to 2019 pre-COVID affected. And Sydney in particular has recovered quite well, and revenue per available room is up a massive 29% compared to pre-COVID levels. And that's been driven mainly by ADR increases, which are up about 8% compared to pre-COVID.
ADR being average daily room rate.
Average daily room rate, up about 8% compared to 2019. But occupancy is still lower than it was across Sydney pre-COVID. And that will change, I think, in the next 12, 18 months. But yeah, those one-off events really do give a good kick at the room rates.
Yeah, definitely.
Short term.
It's one of the reasons people love this sector, and I guess it's one of the reasons we love this sector and we're in this sector. It's very dynamic.
Yeah.
You've got, post-COVID, the sector as a whole has handled it very, very well and bounced back very well. And as Adam was just suggesting and saying that, we've now got corporate travel returning in leaps and drivers. We've got international visitors returning almost already to pre-pandemic levels. So that's only going to bolster existing growth and trade growth that's been occurring across the sector, and particularly into the capital cities.
Yeah.
So.
And so when you're speaking to a lot of the, the buyers out in the market, are they looking towards those capital cities as the kind of premium product, or because I know regional markets got really busy actually during kind of the post-kind of COVID period, or during COVID even?
Absolutely. That was one of the very interesting points of post-COVID. We all fell back in love with the regions. Investors fell in love with the regions.
Well, we were allowed to travel there.
Regional hotels were trading very well. And now, obviously, there'll be we do expect an investor shift back to the capital cities. But interestingly and positively, that investor lens is now a lot wider and has still maintaining an interest in the regions. So we expect that to continue. We've had a number of assets in the market this year. We just exchanged a resort hotel down in Albury just last week. We launched one down in Mollymook just last week. It's been less than a week and we've already had 100 plus inquiries.
Oh, wow.
So
and you've got one up
that's not abating anytime soon.
Up in Byron as well? One up there?
Yeah, we've got the Sun Ranch on the market up in Byron Bay, and again, it's another classic example. People post-COVID were looking for something unique, something different. Up there in Byron Bay, obviously, it's a favoured and much loved destination. It's a real experiential resort experience that we're offering there. It's tapping into wellness, nature, and that's what people are looking for now post-COVID. Really looking for that experience, and investors too appreciate that. Looking for assets that offer something a little bit more.
Yeah. And so with average daily room rates up, occupancy is still holding pretty good, and our outlook for occupancy is probably
better.
quite strong given all those kind of fundamentals with the international visitors. People, like I was in Brisbane. Oh, so we're here in Sydney, but I was up in Brisbane either side of the Taylor Swift, and like the flights were full and super expensive, and the room rates were 300% more than normal. Like
very hard to get a hotel room.
Oh, it was, and that's not the only one. Like we've had, like UFC came to Australia. They were in Perth. They've been in Sydney. We had the Women's FIFA World Cup. We've got Pinks this weekend, I think, in Sydney. Like there's still so many activities going on, which is really great. And like I know it's just kind of blips in the market, but it sets kind of a new benchmark for average daily room rates as well.
I think next year, like over the next 1 or 2 years, you'll see occupancy rebuilding, and I think going forward in this year here, we'll see a lot lower, if not flat, ADR growth in 2024. But RevPAR growth will be driven by occupancy.
Yeah.
So occupancy is still some 8 points below where it was 2019 in New South Wales, and I think next year or this year we'll see ADR growth slower, much slower, if not flat, but RevPAR growth will be built by occupancy.
I suppose that ADR growth really comes also off the back of that kind of increased cost of doing business.
Yep.
Like the payroll it has increased.
Yep. Well, just on that, that growth, that building occupancy will come as group business comes back into the country. So that the volume business, which is the offshore tour groups, China, the business when that builds again, that normally comes through the market at a lower rate growth.
Yes.
At a lower rate, but it brings volume into the market.
Yes.
And that's what's been missing in large in the last couple of years.
Yeah.
And those, as you said, that phenomenal summer of events that we've just had, Taylor Swift, as you said, and everything else, that growth and that trade growth, that's bringing investors back into the market. There were a large pool of people that were probably taking a cautious wait-and-see approach last year, and they will re-enter the market this year.
And do you think the prospect of kind of that financing piece and interest rates, you know, what's widely said 2 or 3 reductions this year, is the hotel market impacted an awful lot by that kind of change in interest rate piece?
Oh, there's less uncertainty going forward this year, for sure. I don't know that a rate reduction will necessarily move the needle that much. We've just gone through one of the most aggressive rate hiking cycles in a long time. So, in itself, that might actually see some sellers out of the market that have now looking at the opportunity to get out. But yeah,
I think it's more clarity going forward. It's more clarity this year than it was perhaps last year.
And it's just that confidence piece.
It's a confidence thing.
Rather than the sitting on the hands, like you said, it's like, you know, start inquiring and looking into it and kind of moving kind of further along the path of perhaps purchasing something.
Absolutely. And Australia is seen as a safe haven in terms of international hotel investment. It's, you know, with international visitors coming back, we're a multicultural society. The world knows us. They value the financial security, the legal security, the stable economy that we've got. It's it all bodes well going forward for us with a return to international investors.
Yeah. So on to a favourite topic. Let's talk about cap rates. Adam, a question no doubt you get asked all the time.
3 times a day.
And there's no real, it's hard to answer, but let's
First thing I'll say about cap rates is that a cap rate is only half the story. So that's a capitalisation rate or yield you apply to the cash flow of a hotel. And over the COVID years, 2021, 22, hotels that didn't have stabilised income required the value to do a forecast on the income. But that income is now there, and I think the net income for a hotel is probably more important for a value than actually what the cap rate is. I mean, cap rates along the east coast of Australia will range between 5 and 7 or 8%, but the most important thing is what you're applying that income to, and whether that's a passing yield, an initial yield, or a stabilised equivalent yield. But broadly speaking now, cap rates are on the rise in 2024, but that doesn't mean that hotel values are going backwards because the income is higher.
Yeah, okay.
So we're getting higher income coming through and a rising bias on that cap rate. But from the overall capital value perspective, at least for prime or CBD assets, it's not having a detriment on valuations because the income is higher.
Okay.
We could stay on this topic for the whole session and really not delve into it, but because I guess that's the other thing with hotels, they're not static assets. You can't compare an apple with an apple, so to speak, in terms of a yield. From my side of things, on the brokerage side of things, we certainly don't see any discounting, and we certainly don't see any pricing going backwards at all. In fact, there's pent-up demand. None of the sales have demonstrated that we can see that there's been a softening of the market. So we certainly don't expect to see that going forward this year. So trade is still growing, as Adam was saying.
Especially for prime assets. I mean, there's actually a lack of supply in the Australian market for premium hotels. Well-located regional coastal assets, prime assets in Brisbane, Sydney, Melbourne.
What about Perth?
Well, Perth. There's not as many in Perth. But
there's been quite a few built in the last few years.
There's quite a bit of volume of sales in Perth in the last 12 months.
Yeah.
Prime assets are hard to come by in Australia.
So if the occupancy, we expect it to continue to improve, and it's already pretty high as it is there a case that we are in an undersupply situation when it comes to hotel rooms in some of these major markets like a Sydney, Melbourne or Brisbane, Gold Coast?
Definitely supply in Sydney in particular is quite benign. There are new projects coming out of the ground, but the demand's there for it.
Yep.
I mean, they've got to keep up with the pace of demand growth, and you see markets like Melbourne over the last 5 years has had a significant supply increases, and that's tempered their RevPAR growth a bit, but the market has absorbed that supply really well.
Yeah.
And I think Sydney has the capacity to absorb that supply quite well, but having said that, there's not a lot on the horizon.
And the cost of construction obviously is a major stumbling block. Like I'm sure it's probably hard to get these projects to stack up, even though there is that kind of demand.
Yeah,
there.
most projects are not always feasible on a FISO, but that doesn't stop developers, investors wanting to build hotels.
Yeah.
So there's still a lot of that proposed in the market, but yeah, supply is not an issue in Sydney.
We've always got older stock being repurposed, repositioned for alternate use, and at the moment I think we've probably hit a supply peak in the cycle, simply because of construction costs and restraints.
I do think when you talk about conversions there, like markets, well, most capital cities obviously having a hard time when it comes to office, vacancy is really high. Is there, a lot of people say to move into residential, which we know is not feasible to do that, but is there an ability to convert to a hotel type product? A little bit easier perhaps?
I think
not sure.
in the current office market now, there's definitely hotels you look at and think, well, that would be a great, so office buildings would be a great hotel conversion. There's opportunity there, it's getting the right floor plate, obviously the right location, but the opportunities are there, particularly on the fringe, or more so on the fringe markets, the CBD fringe areas.
Yeah.
Yeah.
Yeah, that's an interesting space to watch.
Yeah.
And how about those assets that are tenanted then by an occupier? I think you mentioned you had one down in Canberra that...
Leased hotels.
Yeah,
There's
leased hotels.
Opportunity where commercial building operators in the market who prefer to lease hotels. They can get the owner can get a rent similar to, if not more than, an alternate office rent for a leased hotel.
Can you explain maybe for everyone, like what is that leased hotel versus kind of having an...
Well,
that's a hard one for some people to, like that whole
there
idea
is-
of going concern is a bit difficult. I know we weren't going to go down this path, but I think that we should maybe put
There
some
is
framework around
there
it.
is in a minute. I mean, obviously, an operator can either lease a hotel or pay a fixed rent, which may be 20 or 25 grand a key.
Yep.
Or they can run it under a HMA, a management agreement, and collect a management fee along the way. Depends on the operator. Depends on the investor.
Leased hotels are less prevalent in the sector generally. People generally, it's more prevalent to see going concerns. People like to roll their sleeves up and get their hands dirty and run hotels, operate hotels.
Yeah.
So.
And that is something that's very different in this market, is that investors like getting their hands dirty. They like to do the work. They like to see upside in an asset. It's not an asset that you normally buy and just wait. It's something that you can get involved with, and the kinds of buyers in the market. When people buy hotels, they're always buying them on what the hotel can do, not what it has done.
Absolutely.
Yeah.
And even back to the point on inflation and where we've just come from an economic point of view, it further enhances the attractiveness of hotels as an investment class. With as a going concern, you can really adjust your rates overnight in a day.
Yeah.
And
So it's a good hedge against inflation.
Great.
Well,
yeah,
as you said,
absolutely.
hotels have a whale of one day.
Yeah.
So at any
I
point,
love that.
at any point in time, they can adjust their room rates.
Adjusting for
Metaphorically speaking, but they can adjust their room rates to reflect the rising cost of doing business.
Yes.
yeah, and you just don't get that across other asset classes, other sectors, where you've got long-term static rents, etc., leases in place. So it's makes it very attractive for an investor.
Yep.
So we think yields probably stay elevated, but that's not that's given that increase in kind of trading activity.
I think you got to look at
So many
looking at
indicators.
yields, cap rates, and compare it with the operating profit coming out of the hotel. There's a relationship between each. But yeah, broadly speaking, cap rates are on the rise, but that's definitely not putting valuations down. It's actually the income's actually driving valuations higher in most areas.
Yeah.
Yeah. We were talking a little bit about the regional markets. There's been, like, historical, we've had a lot of activity. You've got a few kind of resorts that you've recently transacted. How about, and you mentioned resorts, what about kind of other alternative type accommodation assets like caravan parks? So there's quite a number of caravan parks in the last couple of years. Caravan parks, I got an inquiry about an island the other day. You may not want to talk about that, but is there a bit more activity? Is there demand for those sort of those kind of more unique accommodation assets?
Oh, absolutely. We've sold a lot of caravan parks up and down the east coast, across the country, in fact, over the last couple of years, and that'll continue. That certainly won't die off. You've got this push again. It's just had a resurgence post COVID. There's a push back into the regions, and as an asset class, you've got an underlying large underlying freehold parcel of land and an operating business. So it's they're fantastic assets, and there's a lot more interest in them from a much broader buyer segment too. It's there used to be a real specific caravan park sector of buyers, and we've got buyers coming from all sorts of other sectors, childcare sectors, our traditional pub and hotel investment buyers that are getting interested in those alternative sectors of the market.
And do they like it just for that income stream, or do they like it as an opportunity to, because these are, like, caravan parks are huge.
Yep.
Is it the redevelopment potential of them, or is it a mix of things?
Oh, it's a mix of things, and absolutely every point that you just pointed on there. Yeah, that's the beauty of hotels and leisure assets. There's a lot of operational levers that people can pull, particularly experienced operators, and you can really drive the asset. So, and back to Adam's point on yields, it's people are looking at initial yields and income projections of what they intend to do to drive the asset, more so than what the previous owner has done.
Do you do much stuff, Adam, in these kind of slightly alternative leisure slash?
Well, our team covers all going concern types, from childcare to service stations to boarding houses, motels, hotels, and marinas.
Yeah.
So we cover it all in the
Caravan
team.
parks?
In the team. Yeah, we often do the odd caravan park. But, you got one there, and like I said, they are good assets, and I like them largely because of their land holdings, and obviously regional, but coastal as well.
Yeah. Another thing as well is over COVID, a lot of people got pets. So something like a caravan park that allows people to travel with a pet is becoming kind of increasingly attractive as well. And that's why a lot of those regional motels and stuff, I remember we did a piece a couple of years ago where we saw this huge uptick in regional hotels, and they were all pet-friendly hotels because people like to travel and get in the car and be able to travel easily with their pets. So I'm sure that's a trend that will probably definitely continue. You don't want to talk about islands there, Jacko?
We just saw, it was on the news, wasn't it, just last week? There's airlines now offering flights for pets. You won't catch me on one of those flights, but yeah, it's a trend that looks like it's here to stay.
I was thinking, I can't imagine, I've got 2 dogs, I can't imagine one of my dogs sitting there very politely and just not wanting to jump on everyone as they walk in. Yeah, it'd be an interesting one to watch.
And there's my case in point.
That's sure.
Yeah, so definitely, I think the hotel market is certainly one to watch. I do agree that those high average daily room rates will continue to increase off the back of that increase in tourism, be it international and domestic. We only have to look at retail also here in Sydney. Like, we just did a retail piece recently, and there's so much increase in luxury retail in Sydney CBD. And to be honest with you, that's really targeted at these overseas visitors that do come here and they see Sydney as a destination. So that's only going to continue. With average daily room rates up, occupancy will, even if it stays kind of, occupancy will increase. Average daily room rates might be a bit static. However, we will see improvements in RevPAR, which is going to be a good news story.
Yeah. So in the latter half of last year, and even the January data out today, out this week, that ADR growth is slowing, but it's still there, but it will slow. And it's largely I believe, it's part of that change in the market mix of hotels. And we've had a lot of growth in the last 2 years.
Yes.
So it's got to slow down, and occupancy rate will catch up. So
international travel isn't back to its peak either, so everything's still building.
Yeah.
It's a positive story. Corporate travel's still just, we're only just getting off the Zoom calls and getting back to face-to-face meetings and conferencing.
Yeah, definitely back.
It hasn't got back to its peak yet, and so this year it will continue to build in terms of trade growth.
And we will see those offshore buyers coming back into the market. And also the dollar plays a factor in that also.
Yeah, absolutely.
So with hotels, you're both passionate about hotels. Hotels your thing. So if you were going to invest your hard-earned money, I'm sure it would be in a hotel asset.
Definitely.
Definitely.
How much hard-earned money have you got there, Adam?
I'm a valuer, mate, so not as much as you brokers.
So is there a market in which you would kind of stick with? Where's the best outlook for the hotel sector?
My money is hard-earned.
Why don't we go halves in a capital city hotel here in Sydney? Big rooms factory.
I think room
200
hotels.
200 rooms in the middle of the city. That'll do
would
me.
be ideal now
Yeah.
if I had access to that. Look, I like I like fringe CBD hotels.
So you're doing a conversion of an office building in a fringe market, is what I'm hearing, Adam.
So that's an asset class which is, I think, has got some legs. Conversions of office buildings. But if I had to put money somewhere, yeah, it would be, which is probably not available at a good price, well-located room-only hotel
Yeah.
in the business district of Sydney or Brisbane.
I've changed my mind actually. I'll have a holiday park on the coast. Nice point break out the front of it, and I'll hand a suit in at the door once we finish the interview here. So
Me and you
that'll
both.
do me.
Sounds good. All right. Well, I think that probably wraps us up for today. I think that's been a really insightful discussion, and I do love the hotel market. I think the drivers are really quite interesting, and it has, like I said, it has had a tough run over that COVID period, but it has bounced back really well.
The market held up quite well during the COVID market. Like compared to in the middle of COVID, I was valuing hotels which are literally locked down. They were closed and there was no one in there.
Were you allowed to do that?
Well, they were closed. And valuations, considering what had actually happened, held up reasonably well. And they've definitely bounced back now. And even within those markets, the airport markets of some of the airport markets have been quite strong around the country. And I think will be even stronger in the next 12 months because of the inbound travel.
Yeah. So all that travel will come back. We'll see more. You're already seeing more inquiry. Inquiry will continue to be elevated this year as more certainty occurs in the marketplace.
Absolutely.
And
we've got a number of transactions to announce over the coming months too. So no, we think it's going to be a strong year.
Yeah, awesome. All right, so you've heard it here. If you want to buy a hotel, call Jacko. He can sort you out. Anyway, everyone, thanks so much to Adam and Jacko. I think this has been a really interesting talk. I love hotels, like I said. I like to travel as well, so I hope you've all gotten something out of it, and feel free to hit up Adam to talk more about those capitalisation rates. So thanks so much, guys.
Thanks for having us.
Thank you.
No worries. And just to end, don't forget that, as always, you can share this around on... this link will be available on YouTube. I'll also get it up on our Spotify channel as well, so just search that up. Also, we already have locked in next month's one, which is on the 10th of April. You'll be joined by a couple of our guys that we will talk about high street retail. So pretty interesting. We'll have Scott Stevens and Zorik. So from our Double Bay office, so Double Bay, Mossman, it'll be really, really exciting to talk about all things retail. So otherwise, we'll see you all next time. And thanks again to Adam and to Jacko. Thank you.
Thank you.
Thank you.